At 2:17 a.m., New York time, the screens went dark, not across Wall Street, not across the stock market, just one market, silver. COMEX trading was halted temporarily, according to the notice. No explanation, no reopening time. Within minutes, something more disturbing leaked through diplomatic channels. China had rejected an emergency U.S. request to release physical silver into the international market. No press conference, no official announcement, just silence. And in financial systems, silence is never neutral. By sunrise, analysts were scrambling to explain why over 70% of outstanding COMEX silver delivery requests could not be met. Paper contracts existed, warehouses did not. Central banks did not panic publicly. They never do. Instead, they began calling each other. This episode is not about predicting the future. It's about understanding how a sovereign-level default in silver could happen overnight. Not through fraud, but through structure. Because history shows something unsettling. Monetary systems don't collapse when everyone is reckless. They collapse when everyone follows the rules, and the rules themselves are flawed. To understand how a silver default could occur, we need to strip away the mythology. Silver is not just a metal. It is an industrial input, a monetary hedge, and a geopolitical lever, and it has broken financial systems before. A brief history of silver stress. In the late 1960s, the U.S. ran out of silver, quietly. Rising industrial demand and foreign redemption drained reserves faster than policymakers expected. The response was not transparency, it was demonetization. Silver was removed from circulating coinage, not because it was obsolete, but because it was too valuable. The lesson was clear: when physical metal conflicts with monetary policy, policy wins. The Hunt Brothers episode, 1980. In 1980, concentrated buying exposed how thin the physical silver market really was. COMEX didn't default then. Instead, rules were changed mid-game. Only liquidation orders were allowed. Prices collapsed. The exchange survived by sacrificing price discovery. This is important. Markets don't fail loudly at first. They fail procedurally. Fast forward, the paper. Explosion today, silver trades in volumes that dwarf physical reality. For every ounce of registered silver, there are dozens, sometimes hundreds, of paper claims. Futures, options, swaps, ETFs, unallocated accounts, all legal, all backed. Until delivery is requested. China's quiet position. China is the world's largest industrial consumer of silver, processor of refined metals, exporter of solar and electronics components. But more importantly, China has spent 2 decades securing upstream commodity control. Not loudly, not ideologically, strategically. Rare earths, copper, lithium, and yes, silver. Export restrictions don't need to be announced to be effective. They only need to be enforced quietly. The modern parallel. The modern silver market assumes physical availability, uninterrupted trade, political neutrality. History says none of these are guaranteed. Which brings us to the hypothetical night everything breaks. Here's where the narrative changes. The problem is not that COMEX is fraudulent. The problem is that COMEX is optimized for normal conditions. And sovereign crises are never normal. The delivery trigger. In our 2026 scenario, rising geopolitical stress pushes large industrial users and sovereign entities to demand physical delivery, not cash settlement. This is rational behavior. If supply chains feel fragile, paper exposure is meaningless. COMEX rules allow for delivery, in theory, but delivery depends on registered inventory transport willingness of holders to part with metal. When 70% of delivery requests hit simultaneously, something snaps. The emergency call, U.S. officials reach out to China, not for charity, but for trade normalization. The ask is simple: release silver into global markets to stabilize pricing and settlement. China declines, not publicly, not confrontationally, just declines. No metal moves. The cliffhanger. Question. At this moment, there are only 3 options: declare force majeure, cash settle contracts, close the exchange. All 3 mean the same thing. The paper market has failed to deliver the real thing. What happens next is not chaos, it's accounting. Let's break down how this default cascades through the system. COMEX structure. Explained simply. COMEX is a futures exchange. Most contracts are never delivered. That's normal. And what matters is confidence that delivery could happen. When that confidence breaks, futures pricing loses credibility. Registered versus eligible silver. Only registered silver can be delivered. Most silver in warehouses is eligible, owned by someone who may not sell. This creates a thin delivery base. In normal times, it works. In stress, it doesn't. The repo market connection. Silver futures are used as collateral in short-term funding markets. When delivery confidence collapses, collateral haircuts increase funding, dries up margin call spread. This isn't about silver anymore. It's about liquidity. ETFs and the illusion of access. Silver ETFs rely on authorized participants. If physical sourcing tightens, ETF creation halts, premiums, disconnect from NAV redemptions, spike, retail investors are last in line. Always. Central banks in the shadows. Central banks don't buy silver loudly. They watch. Because a silver failure signals something deeper, paper claims exceeding physical reality. That realization doesn't stay contained. It spreads to gold FX swaps sovereign debt confidence. Why this becomes a sovereign default? No country misses a coupon payment, no bond defaults. But the system fails to honor its implicit promise that paper markets reflect physical reality. That's a default of trust, and trust is the only real currency. This scenario is hypothetical. The mechanisms are not. Every element exists today. Leveraged paper markets, concentrated physical supply, geopolitical leverage, confidence-based settlement history doesn't repeat. It rhymes structurally. Silver doesn't break the system because it's small. It breaks the system because it reveals what is real and what is promised. And once that question is asked, it doesn't stop with silver. Financial crises don't begin when assets disappear. They begin when everyone realizes they were never really there. If you want more money over history, not predictions, not panic, but systems explained, subscribe. This channel doesn't tell you what will happen. It shows you how it could.